of inventory and intra-group receivable. So, intra-group transfer of inventories. Intra-group transfer of inventories. In the group point of view, sales mean the sales of an item to non-group members. The sales of an item between the group and the parties outside the group, that's in the middle of sales. In the group point of view, sales mean the sales of an item between the group and the parties outside the group. Where the members of the group sell an item to the other member of the same group, the item is assumed to be transferred between the group. We don't regard that as a sales. That is, where the parent sell to subsidiary or subsidiary sell to the parent, that item is assumed to be transferred between the group, not the sales. And where there are transfers between the members of the group, the transfer should be made at the cost to the seller. Where there are transfers between the members of the group, the item transferred should be made at the cost to the seller. That is, members of the group are not allowed to make profit on the transactions between the group members. Members of the group are not allowed to make profit on the transactions between or among the group. That is, where the transactions are made at a profit, the profit on the item transferred should be eliminated, provided the item is still in the inventory. That is, you will need to calculate the unrealized profit on the portion of that item that have not been sold by the purchaser to the third party. You calculate the unrealized profit, that is the profit element, on the portion that have not been sold to the third party, then you eliminate it. Realize means to sell. Realize means to sell. Why unrealized? Unrealized means not yet sold. That means unrealized profit should be calculated on the portion of the items that have not been sold to the third party. So, the knowledge of markup and margin will be needed here. What do you mean by markup? Markup is the profit expressed as a fraction or percentage or percentages of the cost price. Markup is profit calculated on the cost price. Profit expressed as a fraction or percentage of the cost price. Markup is equal to profit over cost price. That is markup. While margin is the profit calculated as a fraction or percentage of the selling price. That is margin. The profit calculated as a fraction or percentage of the selling price. That is margin. Meaning that when markup is given, your profit will be equal to percentage markup times cost price. Where profit margin is given, profit will be equal to percentage margin times selling price. But in the group, the value of the people will be the selling price. Since the buyer will record what will be the cost price to the buyer, or the item transfer will be the selling price of the seller. So, and how will you know when markup is given? Oftentimes you will be given cost plus, or if they don't mention markup on cost. So you will be given cost plus. Anytime you have cost plus, whether that is a markup. To convert markup to margin, you add the numerator to the denominator. If the percentage markup is, let's assume it is 20%, which is 20 over 100, margin will be 20 over 100 plus 20, which is 20 over 120. Don't forget, unrealized profit should be calculated on the unsold items. Unrealized profit should be calculated on the unsold item. That is the portion that have not been sold to the third party. Take note of that. Then the second item I'm going to look at is intra-group receivables. Intra-group receivables. Consolidated financial statement should contain only the transactions between the group and the parties outside the group. Only those things that will be consolidated will be the transaction between the group and the parties outside the group. Anything that occurs between the members of the group should be eliminated. Therefore, intra-group receivables should be deducted from the consolidated receivables. Consolidated receivables and consolidated payables. Intra-group receivables should be deducted from the consolidated receivables. At the same time, it should be deducted from the consolidated payables. That is, the double entry to eliminate this is to debit consolidated payables and credit consolidated receivables. That is the double entry to eliminate the intra-group receivables. Now, back to unrealized profit on intra-group transfer. It is the seller that have recognized that profit in his financial statement. No, it is the seller that transfers at the market price. It is the seller that have made the profit. So, in that case, where there are intra-group transfer of inventory with the unrealized profit, deduct the unrealized profit. Deduct the unrealized profit from the retained earnings of the seller. We have the parents of the seller. You deduct the unrealized profit from the retained earnings of the parents in full. Don't apportion this amount. We have the subsidiary is the seller. You deduct the unrealized profit from the retained earnings of the subsidiary in order to obtain the adjusted post-acquisition profit of the subsidiary. Since the post-acquisition profit of the subsidiary will still be shared between the parent and the seller. So, I am not going to follow the explanation here, but I have to explain it because you will be consulting some rule and they might follow this way. So, the second approach I've given you, just follow my explanation, you will arrive at the same end. This approach is more easier. Deduct the unrealized profit from the retained earnings of the seller and from the consolidated inventory, whether the policy is proportionate or fair value. deduct unrealized profits now. So, unrealized profit. I said if you deduct it from the retained of the seller, that is debit retained earnings of the seller, whosoever that sells. Parent might be the seller. Where parent is the seller, you deduct it from the retained earnings of the parent. Where subsidiary is the seller, you deduct it from the retained earnings of the subsidiary. Then you credit consolidated inventories. Just follow this approach. It will solve our problems. So that is the treatment of unrealized profit. Debit the retained earnings of the seller, credit the consolidated inventory. That is, you deduct the unrealized profit from the retained earnings of the seller and you deduct it from the consolidated inventories. So we want to take a question as a work example. Question as a work example. Being acquired 80% of the shares in ESCO 1 year ago. When the reserves of ESCO stood at $10,000. Draft statements of financial position for each companies are the people for people and ESCO. The people PPE, investments, current assets, total assets, equity, ordinary shares, retained earnings, current assets, liabilities, total equity and liabilities. Then you have the notes. During the year, ESCO sold goods to PICO for $50,000. The profit to ESCO being 20% of the selling price. That is to show that this is profit margin. This is margin because it's on the selling price. At the end of the reporting period, 15,000 of these goods remained unsold. That means your realized profit will be calculated on it 20% of 15,000 because it is the portion that remains unsold. The item sold is it's worth 50,000, but the one that remains unsold, the one that has not been sold to third party, I told you that the unrealized profit should be calculated on the portion of that inventory that has not been sold to the third party. So that means unrealized profit should be calculated on 15,000, not 50,000. Of these goods remain unsold in the inventories of PICO. I say the PICO owed ESCO 12,000 for goods bought, and this debt is included in the trade payables of PICO and the receivables of ESCO. I told you that intergroup receivables should be eliminated from both the receivables, consolidated receivables, and the consolidated payables. NCI is valued at fair value. The policy is fair value. It was valued at 9,000. That is the fair value of NCI at the date of acquisition. Required to prepare a draft consolidated statement of financial position for PICO. So that is the question. So solution. After the first thing is to present a summary of the subsidiary net assets. The subsidiary is ESCO net assets. Summary of the subsidiary net assets. So we have post acquisition retained earnings. We have the net asset at the date of acquisition. We have the net asset at the date of consolidation. Everything is in dollar. After that, the net assets are equity. If you look at the equity, there are two components of equity in the question: ordinary shares and retained earnings. So that of the subsidiary is what we are concerned with. So we have 30,000 and 22,000. So we have ordinary shares and retained earnings. The ordinary shares of the subsidiary is 30,000. While the ordinary the retained earnings of the subsidiary is 22,000. 22,000. Now, since there have not been any further issue of shares after acquisition, that means the share capital at the date of acquisition will still remain as 30,000, no post-acquisition. Then retain earnings. I've told you that you are going to slash your retain earnings between the pre-acquisition period and post-acquisition. Now, go back to the genesis of the question. Pico acquired 80% of the share in ESCO 1 year ago when the reserves of ESCO stood at $10,000. The $10,000 represents the pre-acquisition reserves. This question is obtained from ACCA study test by BPP learning ACCA. So the pre-acquisition reserves is 10,000. 10,000. If the pre-acquisition is 10,000 and the accumulated reserves is 22,000, the post-acquisition reserves will be 12,000. Now let's go back to the note. During the year, ESCO goes to Pico for 50,000. The profit to ESCO being 20% of the selling price. So we calculate the unrealized profit. 20% of the selling price. I told you that you calculate it on the portion not yet sold, which is 15,000. 20% of 15,000. PUP means provision for unrealized profit. Provision for unrealized profit. 20% of 15,000. The unrealized profit is $3,000. I told you that this unrealized profit, I said it should be deducted from the retained earnings of the seller. Then you now ask yourself, who is the seller between Pico and ESCO? During the year, ESCO sold. ESCO sold. That's to show that ESCO is the seller. If ESCO is the seller, the unrealized profit should be deducted from the retained earnings of ESCO. Remember, the net asset here is the net asset of ESCO. That is what I deducted that 3,000 from the post-acquisition profit of ESCO. Where Pico is the seller, where parent is the seller, we will not even have it here. We will not have it in the summary of net asset. It's where you are calculating the consolidated retained earnings that you are going to have that 3,000 here. So, then the net asset. So, we have, this is 22, then 52. 30 plus 22, that's 52 minus 3,000. That will give us 49,000. Here we have 40,000. 30,000 plus 10,000. 12,000 minus 3,000 will give us 9,000. That is the summary of the subsidiary net assets. That is working one. The second working is the calculation of goodwill, working two. Goodwill on acquisition of ESCO. Acquisition of ESCO. I told you that goodwill is the consideration transfer. Consideration transfer. The amount of consideration that was transferred, the purchase consideration, the price paid on acquisition of subsidiary net asset is $46,000. Investment in ESCO at cost. I told you that the consideration will appear as investment in the statement of financial position of the parent, which is 46,000. So we have 46,000. Then we add the non-controlling interest. The fair value of NCI is given, since the policy is fair value. And the fair value of NCI is going to be 9,000. So we add the 9,000. 46,000 plus 9,000, that will give us 55,000. At the juncture, now deduct the fair value of net assets at the date of acquisition. The less the fair value of net assets at the date of acquisition, and that has been calculated above. One at the date of acquisition is 40,000. So when you less the 40,000 from 55,000, then you have a goodwill of 15,000. That is goodwill, which is 15,000. No impairment of goodwill. Having calculated the value of goodwill, the next thing is the calculation of the retained earnings. Retained earnings. Working three. We have retained earnings. Retained earnings. So, to compute the retained earnings, you start with that of the parent. Retained earnings of people, which is the parent, which is 45,000. People retained earnings as per the statement of financial position, and that is 45,000. 45,000. After that, you now have the parent shares of the post-acquisition retained earnings of the subsidiary, which is 9,000. The adjusted post-acquisition profit of the subsidiary has been calculated to be 9,000. Then you calculate the parent shares of that. So we have people share of adjusted post-acquisition retained earnings of ESCO. We are going to apply the percentage of PICO holding. What people acquire in ESCO is 80%. That is to show that PICO will receive shares, 80% shares of the ESCO post-acquisition retained earnings of 9,000. Then we have 80% of 9,000, and that will give us 7,200. So when you add it to 45,000, that will give us 52,200. That is the consolidated retained earnings. The next thing after this is the non-controlling interest working for. Non-controlling interest. So you start with the fair value of NCI at acquisition, which is 9,000. Fair value of NCI at acquisition. Fair value of NCI at acquisition, which is 9,000. Then you now have NCI share of post-acquisition retained earnings of ESCO. Since parent had acquired 80% of the shares in ESCO, then the remaining 20% will be attributable to NCI. You have 20% of the post-acquisition profit of subsidiary, which is 9,000. 20% of that 9,000. That will give us 9,000 times 20%. That will give us 1,800. When you sum it up, you have 10,800. That is the value of non-controlling interest that will appear in the consolidated statement of financial position. Now, we can now go ahead preparing our consolidated statement of financial position. So we have PICO group. Consolidated statement of financial position. And what is the year end? As at okay, you are not given the date. We're only to subsidiary was acquired a year ago. Okay. Consolidated statement of financial position as at whatever date you have in the question. But since there is no date in this. So you have assets. The first asset should be the non-current assets. Non-current assets. As part of our non-current asset, if you check your non-current assets, the first class we have here is property, plant, and equipment. Property, plant, and equipment, which is 80,000 plus 40,000. And that will be 120,000. 120,000. After that, we have the goodwill. Our goodwill is obtained from the working tool. Our goodwill is 15,000. Working tool, and that is 15,000. The total of non-current assets is 135,000. After non-current assets, then we have current assets. Current assets. The current assets, that of PICO is PICO current assets is 40,000, and Esco's current assets is 30,000. We have 40,000 plus 30,000. We also have intergroup debts. Intergroup debts are the same date. PICO owed Esco 12,000 for goods bought, and this debt is included in the trade payables of PICO and the receivables of Esco. That intergroup debt should be eliminated, minus 12,000. Then we also have an unrealized profit from intergroup transfer of inventory. Remember, receivable is part of the current asset. That is why I have deducted this 12,000 from the current asset. Don't forget, intergroup receivables should be deducted from both the trade receivables and payables. Consolidated receivables are consolidated payables. So, since receivable is part of current assets, so we deduct it from current assets. Then the unrealized profit, inventory is part of our current asset too. Inventory is part of our current asset. The unrealized profit, which we have calculated to be 3,000, so we call it eliminate it. And 3,000. So we have 40 plus that is 70 minus 12 minus 3. That will give us 55,000. So when you add it to 135,000, the total asset will be 190,000. That is total assets. Total assets is 190,000. Having calculated the total assets, the next thing should be the equity and liability section of the statement of financial position. We have equity and liabilities. Equity and liabilities. As part of our equity, we have ordinary shares. Ordinary shares. That of the parent, which is 100,000. Ordinary shares of 100,000. Then we also have retained earnings from our working tree. Retained earnings, retained earnings, which is 52,200. Then when you sum it up, you get the equity attributable to the owner to be 15200. Retained earnings is working three. Then we have non-controlling interest. Non-controlling interest. That is working 4. Non-controlling interest. And we've got 10,800. 10,800. So you add 152,200 plus 10,800, and that will give us 163,000. That is the total equity. After total equity, we have the current liabilities. Current liabilities. Current liabilities. Current liabilities. That of the parent is 21,000. And the current liabilities of subsidiary is 18,000. 21,000 and 18,000. Then after that, intra-group receivables should be deducted from the consolidated receivables and the consolidated payable. So the 12,000 should be subtracted from the payables as well, since your payable is part of the current asset. 21,000 plus 18,000 minus 12,000. That will give us 27,000. If you add the 27,000 to 163,000, then you have 190,000. That is total equity and liabilities. Total equity and liabilities. So that is the treatment of intra-group transfer of inventory